Oga Ken, I got here before you.
Hello. Well done. How are you?
How's it going?
Okay. Awesome. Good to see you. So let's make sure. So who's here is not here. All right, so I'm gonna step away briefly and come back. Let me just make sure everything here is working.
Okay.
Yeah.
Hi, Angela. Good morning.
I know what I need to pause. Can I pause the recording and restart? Yeah, I think I can pause. So let me know if you can all see my screen.
Yes.
Yes, we can.
Okay, awesome. Some stuff. Okay, all right. So welcome everyone to this webinar. So let's get started. All right, so this presentation, I think it should take about anywhere from 30 to maybe 40 minutes. And I'm just gonna go through a few things and it may be quick. So what I would suggest is if you have questions, you can write them down, you can put them in the chat. And at the end of the presentation, we can now do question time. Okay, and I'll be happy to answer all your questions. Okay, all right, so let's get started. So in terms of agenda, I'll just talk briefly about my story. Most of you already know who I am. I'll talk about what is a tax-efficient financial plan. We'll go through some foundational things that I think you should all know as you prepare for your personal taxes. We'll go through the key building blocks, and I'll talk briefly about the framework that I use when I work with my clients and what I suggest that you all can also use. And then we'll talk about some tax tips, and I will share a lot of resources with you as well, so that way you have all the information you need at your fingertips. So briefly about me, immigrated to Saskatoon way back in 2002. Moved to Toronto to do my MBA at the Schulich Business School. And then once I finished my MBA, I joined PricewaterhouseCoopers, where I worked for a number of years in Canada here and briefly in the US. And then spent some time working at different Canadian banks between 2010 and 2016. And in 2010, just after I left PricewaterhouseCoopers, I started running my accounting practice on a part-time basis. And then in 2012, I met with my business partner, Celia, and we started our accounting firm. So we've been running the accounting firm since 2012. So that's almost 12 years now. How time flies. So I was doing part-time while she was full-time. And in 2016, I joined her in the business full-time. So as some of you already know, I'm a real estate investor. And I call myself a chess enthusiast, as some of you know. The two things I love to do outside of work, real estate and chess. I did write a book, Tax Efficient Wealth. I think some of you have read it. For those of you that have not, I'm going to share some resources with you. That is a copy of the book here. It's an easy read. It's just going to take you 2-3 hours at most to go through the book. And then I created a platform called taxefficientwealth.ca. So it's a group of members. We're relaunching this in March. So for those of you that are interested, I'll share a little bit about that as well. So why taxes and why does it matter, right? A lot of us don't think so much about taxes. And the reason for that is because we don't even know how much we pay in taxes, right? So if you're employed in Canada, All you do, you get your deposit or your paycheck every 2 weeks. And all that matters to you for the most part is just how much that hits your bank account. But sometimes we don't realize how much we pay in taxes. And so that's one of the reasons why I'm having this presentation today, to let you know that taxes is likely your biggest expense. Recently, with the increase in inflation, with increase in interest rates, maybe housing costs, food costs, all of these things are competing now. But I think depending on your income, depending on where you live in Ontario, taxes is likely going to be one of your biggest expense, if not your biggest expense. So as a result, it is a major obstacle when it comes to building financial independence, okay? And so that's something we need to plan for so that we can overcome those obstacles. You also have to realize that $1 lost in taxes is worth much more than $1 itself, right? And this is because if you think about the potential of that dollar over 5 years, 10 years, 20 years, you begin to realize how important it is to save money or to save money in taxes, okay? So that's one of the things to have at the back of your mind when you're thinking about how much you're paying in taxes. And some of you are familiar with this. So what you make is not as important as, or what you make is not as important as what you keep, right? And so you may make $100,000 every year in income, $200,000 every year in income, but if you're paying it all out in taxes, then you're diminishing your ability to build wealth. And so that's why it's so important for you to try to minimize your taxes and keep as much as you can for your future. So what is a tax-efficient financial plan, right? And this is the reason I wrote the book. This is the reason I talk all the time about tax efficiency, because I think this is one of the big hacks when you want to build wealth, when you want to build financial freedom. If you can minimize the amount of taxes you pay, then you begin to make improvements. And if you're investing those dollars wisely, then you can really accelerate the way you grow your wealth. So I define a tax-efficient financial plan as an intentional financial plan designed to minimize or eliminate taxes. Okay, so that's what we want to accomplish. We want to minimize taxes, or in some cases, we just want to eliminate it completely. So an efficient tax plan seeks to do three things. Okay, so one is to save money tax-free or tax efficiently, to allow that money to grow tax-free or tax efficiently, and finally, to distribute that money tax-free or tax efficiently. Okay, so we start by earning income. We want to take that income and save it tax-free. We want that money to grow tax-free. And at the end of the day, once we start drawing on that money, whether when we retire or during while we're still working actively, we want to take it out tax-free. Okay, so that is the whole goal, either tax-free or tax efficiently. So now, to do that, I think it's important for you to understand some foundational stuff when it comes to taxes. Some of you may be new in Canada, right? And so Canada, our tax system is so different from back home in Nigeria, where we came from, right? I don't know how many people know about taxes in Nigeria. I don't know much in taxes in Nigeria. I never studied tax in Nigeria. But one thing I know for sure is that taxes in Nigeria is much lower than taxes in Canada, okay? And so that's why it's good to know a few things. For those for clients that I work with, I always try to educate. Whether you work with me or you work with a different tax professional, it's just best for you to understand some of these basics so that you can challenge, so that you can ask intelligent questions, and so that way you know exactly what's happening to your money. So let's go through some of the foundation. I like to start here when it comes to mindset. I think mindset is very, very important, because if you don't have the right mindset, then it becomes challenging to understand how to grow your wealth and the things that you need to do to stay ahead. So that's why I think mindset is very important, right? So there are two extremes. There's a scarcity mindset. There's also the worth mindset, right? You need to have an abundance mindset, or you have a scarcity mindset. So better to understand those two extremes. Most of us will fall in between. Okay, most of us will fall in between. So the scarcity mindset, when you have a scarcity mindset, what does that mean? It means you're always stressed, you're anxious, you have a lack of generosity, all right? And so all these things may impact the way you view wealth. When you have an abundance mindset, you're more calm, you're positive, you're optimistic, right? But again, at the end of the day, most of us will fall in between those two extremes. Okay, so what I would suggest is you consider ways you can change your mindset, right? And this is something we can all do. We can improve how we view money, we can improve how we view wealth, and we can work on changing that. And I think if you have the right mindset, then you begin to view money differently, you begin to view your actions and relationship with money differently, and you begin to take the right set of actions to achieve wealth and to do the right things when it comes to your money. Okay, so it's always good to ask yourself some important questions. Okay, for example, what comes to mind when you think about money, right? What are some of the significant money wins you've had in the past, over the last 10 years, over the last 5 years? And then once you start asking yourself all of these questions, you begin to reframe the way you think about money, and you begin to reframe the way you spend, the way you save, and all of these things you can change when you have the right mindset. And later, I'm going to share a resource with you where you can take a quick 2 minutes test just to get a better understanding of where you stand when it comes to your money mindset. The second thing I want to talk about is getting familiar with some of the foundational tax concepts in Canada. And this is something that will be new to most of you, because if you're not a tax professional, or if you're not interested in understanding some of the foundational concepts in tax in Canada, you probably don't know any of these things, right? But I think it's important you understand these things so that way, when you're looking at your tax return, when you're having discussions, you can look at these things a little bit more intelligently than most people. So what's the basis of tax in Canada? Okay, so in Canada, taxes is based on residency. Okay, so if you're a Canadian resident, regardless of where your income is coming from, if you're a Canadian resident, you're taxed on your worldwide income. Okay, so if I'm a Canadian resident and I make money from Nigeria, I make money in the UK, I make money in the US, I have to bring all of that income and put in my Canadian tax return, and I'm going to be taxed on all of my worldwide income. Okay, so that's the basis of tax in Canada. If you're not a resident in Canada, then you don't even have to file taxes in Canada because you're not a resident in Canada. However, if you're a foreign resident, let's say you're a foreigner, but if you have income in Canada, you have property in Canada, then you have to file a non-resident tax return. Okay, so those are the two types of tax return. If you're a non-resident and you have income in Canada, you only file a non-resident tax return for the income earned in Canada. Okay, but again, basis of tax is based on residency. Yeah, okay. So now let's talk about the marginal tax rate system. So in Canada, our tax rate system is marginal. What that means is the more money you make, the more taxes you pay. Okay, so we have a marginal tax rate, and I'm going to show you that shortly. The tax rate will escalate as your income rises. Okay, so the more money you make, the more taxes you pay. Then there are the 2024 tax rates, and that is what I want to show you. So this is what the tax rates look like in 2024. Okay, so this is the combined tax rate for federal and provincial. Okay, so the federal level, we have a set of tax rates on the federal level. We also have a set of tax rates on the provincial level. Okay, so what I've done here is to try to combine both of them. Okay, so this is just a combination of both of them on the average, on an average basis. Okay, so you'll see the first line there. It shows your personal tax amount. So what that means is, on the average, if you make $13,000 on the average, you pay no taxes. Okay, in Canada, if you make about that amount every year, you pay no taxes because that's your personal tax amount. So you get a credit for that amount. Then the tax rates begin to increase gradually. Okay, so if you make $49,000, you pay 20%, 20.05% on the difference between 49,000 and that 13,000. Okay, and then if you make anywhere between 49 to 53, your tax rate will not jump up to 24%. Now that 24% is going to be taxed on the marginal increase. Okay, and that is how we calculate taxes in Canada. Okay, so you may pay 20% on 49, but the 24% rate will be applied on the difference between 53 and 49,000. Okay, and that's how we go about calculating our personal taxes. And then it goes on until you get to over $235,000. And then that's when you start paying that marginal rate of 53.53%. So at the end of the day, you see here that our tax rate is quite high when you look at the tax. Oh, sorry, I don't know why. There's something wrong with this. Okay. So we, let's see. Let me go back. Okay, so we talked about basis of tax, we talked about personal tax rates, talked about the calculation of personal taxes, right? Again, personal taxes based on marginal tax rate that we just went through. Not all income is taxed alike. Okay, so this is another important point to understand. Not all income is taxed alike. So what that means is, depending on the type of income you earn, the tax rates may be different. So for example, tax on capital gains will be different from dividend tax, will be different from tax on ordinary income. Okay, so capital tax gains, if you own a rental property, you sell it, you pay capital gains tax, which is only 50% on your gain. Okay, dividend tax rate are slightly lower, particularly if you're earning dividend from Canadian corporations. And then there is tax on interest income, which is quite high, and there is tax on ordinary income from our employment. So depending on the type of income you earn, your tax rate will be different. Now, tax credits versus tax deductions. It's also important to understand the difference between tax credits and tax deductions. So tax credits are credits that we get, that we use to reduce the taxes we owe. And later I'm going to go through some examples of those tax credits. Tax deductions, on the other hand, is what we use to reduce our gross income to our taxable income. Because in Canada, we pay taxes on our taxable income. So you can earn $200,000, but you may have some deductions that can reduce your $200,000 to maybe $150,000. And now your taxable income becomes $150,000. Okay, so it's better to understand the difference between tax credits and tax deductions, and later I'm going to show you some examples of that as well. Tax deferred and tax free. So oftentimes people confuse these two terms. So tax deferred means I don't have to pay the taxes today, but I have an obligation to pay it sometime in the future. So if some of you are familiar with the RRSP, so the Registered Retirement Savings Plan, that is an example of a registered retirement, is a tax deferred vehicle. Okay, so what that means is you're deferring the taxes to sometime in the future. So when you start withdrawing from that account, that's when you pay the taxes. Tax-free is totally different. So tax-free means you don't pay taxes at all. Okay. So for those of you that have a tax-free savings account, that's what it means. So once you put money in that account, all the interest or income earned in that account is tax-free. Okay, so there is a difference between tax deferred and tax-free. So I also like to talk about the three powerful wealth accelerators, because this is something that I discuss in my book. And so I will recommend some of you to, if you've not read the book, to pick it up and read. And this is something that you use when you want to accelerate the way you grow your wealth. Okay, compound interest. Understanding the importance of compound interest when it comes to how you invest. Right, earning interest on interest, and the power of compound interest in accelerating the way you grow your wealth. Leverage. For those of you that own real estate, that invest in the stock market, or maybe you have a certain insurance vehicle, right? So this is just leverage. Leveraging is a wise use of debt to grow your wealth, okay? And that's something real estate allows us to do in this country. And finally, velocity. So velocity is just how fast you keep your money in motion. Okay, just regularly investing and making decisions quickly, and just making sure that your money never sits idle. Okay, so all these concepts are very, very important when it comes to building financial prosperity. It's also important to understand some of the obstacles we face when we are growing and building our wealth. Taxes is one of the big ones, and I talked about that earlier. Non-deductible interest is another big one, okay? And this is applicable to us in Canada here because we don't get to deduct the interest that we pay on our mortgages, on our principal residence, right? So that's the big difference between Canada and the US. If you're in the US and you own your home, you can write off your interest against your taxes. You can deduct it against your taxes. So in Canada, we don't have that option to deduct our interest against our houses. And this makes sense because if you look at our mortgage is our biggest debt. And with the high prices of houses in Canada here, particularly in Ontario, then it's very common to have people carrying $1 million in mortgages, 500, 600. And if you begin to add the interest on those mortgages, is significant, right? And the fact that we cannot deduct those interests is a big obstacle, okay? And we have some ways you can get around that. Then there's a cash flow crunch, right? So I talked about the fact that when you are employed here in Canada, they take all your taxes before you even get your money, right? But that's different from someone that owns a business, because if you own a business, you get all your cash up front, you write off all your expenses, and then whatever is left, you pay taxes on that and send to the government, okay? And so you begin to see the difference in cash flow between those two people, right? When you're running your own business and when you're employed. But again, obviously, you have to be careful the way you manage your cash so that you're not in a situation where you're owing taxes. Then inflation is something that we are all familiar with, right? So inflation puts a lot of pressure on our cash flow, on our income, and on our ability to grow our wealth as well. So the good thing that in Canada is that the government allows us and gives us a few tax-free options. And I think it's important for all of you to be familiar with this, because now when you know this, then you can obviously use this to your advantage. So the first one is our principal residence. Okay, so that is one of the biggest benefits in Canada here, that we as Canadians, we don't pay taxes when we sell our principal residence. Okay, so your principal residence is your home. Okay, so if you buy your home and your home appreciates in capital, and again, when you sell it at a future date, you don't pay taxes again. Okay, so that's one of the reasons I recommend everyone to try to buy your home, your personal home, and then try to move maybe 2 or 3 times while you live in Canada. Okay, so that way you can continue to do the same thing over and over again. Tax-free savings account. So a lot of you are familiar with this account. So we put money there, we put our after-tax dollars there, and then that dollar grows tax-free. Then there's a new one that the government launched. So this came in last year, the first home savings account. And so if you have this account, again, you don't pay taxes on the growth, on the income in this account. Then there's a tax-exempt life insurance that most people don't know. Life insurance is a vehicle that you can also use, and all the gain from that life insurance proceeds is tax-free at the end of the day. Then there is a lottery. Okay, so in Canada, we don't pay taxes on lottery winnings. It's not something I recommend, but if you play lottery, if you gamble, then of course, obviously, you now have a reason to gamble if that's something that you do. But it's not something I recommend. Then obviously others, things like equity, debt, leverage, all of these things, we don't pay taxes on those, right? So if you take on debt, if you pull equity from your home, from your investments, obviously there are no taxes on those. So now I'm gonna go and shift a little bit into some of the key building blocks. So now that we have all of this information, we've talked about some foundational stuff about taxes. We've talked about some of the obstacles that may affect the way we grow our wealth. Let's talk about some of the building blocks in terms of growing wealth, right? So the most important thing is, first you have to make money, you have to grow that money, and you have to keep it. So I always encourage my clients to explore ways you can make more money, okay? Explore ways you can make more money. Work on ways you can multiply your money once you make the money, so that way you can grow it tax efficiently, right? So if you have employment income, that's one way you can make money. You can start a side business. You can obviously invest in businesses, in other things to make more money. And then once you do that, you can begin to explore ways to multiply your money through some good tax-efficient investments. And obviously, think of ways to protect your money, right? Very, very important, so that you don't lose your money unnecessarily. Obviously, you end up losing money because investments always involve risk. So there is always a chance when you take risks that you lose, but you try to minimize the losses as much as you can. Try to build assets that generate income and cash flow, okay? You build assets that have potential to grow. You also build assets that have the potential to generate income for you. Later, I'm gonna share the top 10 characteristics that I think you should be looking out for whenever you're thinking of investing your money. And some of them you can see on this image on the right? So tax efficiency, safety, growth, cash flow, guarantee some protection. So these are some of the things to consider when you're looking at different investment options for your money. Okay, so I'm not going to spend so much time here. So this is a framework I use when I'm working with clients on a coaching or consulting basis. Okay, so framework for building tax-efficient financial plan. But I'm just going to skip through this very briefly, but I think it's something you can consider when you're trying to plan for yourself as well. And later, I'll also share these slides with you so that way at least you have all the information. So it's a framework I call GASTER. You start by setting your goals, you assess where you currently are, you look at the structures that you have, because I think structure is very, very important when you're building wealth, because every structure is taxed differently. And then you begin to think of ways to employ and to improve the tax efficiencies in your structure. Then obviously you now have to take actions and then review along the way. So goals, we all have to come up with ways of setting goals. And there's something I shared earlier, I may have it somewhere, in terms of how to go about setting your goals. You dream big, set both long-term and short-term goals. You assess where you are. Okay, so this is taking an inventory of what your current assets are, your liability, what your income gap is. In this way, I'm talking about all your income, all your expenses, looking at your insurance, and then consider whether you're using all these tools, particularly these tools that allow us to grow our money tax-free. Okay, so these are some of the things you do at this stage. And then think about your structure. You got to optimize your structure. Okay, as I talked about earlier, if you earn money personally, that money is going to be taxed differently compared to if you earn it in a corporation or if you earn it in a trust. Okay, and so it's important to consider your structure, because if you have the right structure, it will help you improve your cash flow, it will help you defer, or sometimes even minimize taxes. Then the next one is tax efficiencies, right? So this is what we talked about earlier. We want to save money tax-free or tax efficiently. We want to grow it and we want to be able to withdraw it. We'll think about ways to employ leverage, compound interest, velocity, and making sure we're using all the tools to allow us to do that. And then we'll go into action, right? So, breaking down all your long-term goals into actionable steps you can do every day, with every week, and even in the next 30 to 90 days. And then you begin to develop habits to allow you to do this. I always recommend building accountability as you go ahead to accomplish your goals. And that's one of the reasons I launched this tax efficient work membership platform, as it helps us with this accountability framework to continue to make progress. And then finally, you just want to continue to review and to make changes, right? So you're learning from what you've done, learning from your mistakes, learning from the things that are working, and so that way you can continue to do more of those things that are working for you, and then make changes where you need to make, and then just continue to achieve good results. So this is just a summary of the framework here, and I'll share this with you later to review. So what's new? So for those of you that have been filing taxes for many years in Canada, you realize that things change all the time, okay? And so there are new things that come up from time to time. So these are some of the things that have been new, either new this year or new from last year, right? So things that are still fairly new. So there's a first-time home buyer's amount. So for many, many years, it used to be $5,000. But that has now been increased to $10,000. Okay, and so this is a non-refundable tax credit you will get once you buy a home for the first time. Okay, so if you bought your personal residency for the first time in 2023, then you have this credit that you can use. Okay, and again, this credit is on at 15%. Okay, so don't forget that when you're filing your taxes. There's a climate action incentive that has now been changed from a refundable credit to quarterly payments. So now every quarter, some of you may have been getting this payment because it started in July 2022. Then for those of you that are teachers, again, you're eligible for this credit. It used to be 15% during the COVID time, but now it's been increased to 25%. And so these are for eligible expenses that you've incurred just to support the work that you do for your students in school, in the classroom. Then the first home savings account. So there's something that is due, came into effect in 2023. So if you've not bought your home, I would highly, highly recommend that you set up this account. So that you can use this when you're buying your home for the first time. It allows you to put some money away to be able to buy a home. Disability tax credits. So there's something that was added before. So now if you have type 1 diabetes, you now qualify for this credit. And the good thing about this is that it is retroactive to 2021. Okay, so regardless of whether you filed your taxes or not, you can now go back and amend those tax returns to get this credit and then that way you get some refund when you do that. There is the zero emission vehicle credits. So if you buy a zero emission vehicle, you have this credit that you can use. It's been extended to 2025 and is up to $5,000 in your tax return. RRSPs, again, for those of you that have RRSPs, you can always contribute. So there's a contribution limit that changes every year. In 2023, it's $30,780. We expect it to increase to $31,560 in 2024. Then the TFSA limits as well. Okay, so this is the maximum contribution. So TFSA started several years ago. So up to 2023, your maximum limit is $88,000. So what that means is that's the amount you can contribute into that account. And for this year, it's gone up to $95,000. Again, remember, if you put this $95,000 in this account, if this account now grows to $1 million, you don't pay any taxes. So now you have $1 million you can withdraw tax-free. Anti-flipping legislation. So this is something that is new. Okay, a lot of people are not familiar with this. So there are lots of real estate investors and a lot of people that flip real estate property. Okay, so what this means is if you buy real estate and you hold it for less than a year and then sell it, you are not entitled to capital gains. So you have to pay tax on the entire gain. Remember what I said earlier, if you own real estate, particularly rental real estate, when you buy it, let's say you bought it for $100,000, you sold it for $200,000, so you have a gain of $100,000. You only pay capital gains, capital taxes gain on half of that. So in this example, you're going to pay taxes on $50,000. Okay, but that is only applicable if you have that property for more than a year. Okay, and so that's why they introduced this legislation, because a lot of people were flipping properties and they were doing it so frequently. And so the government had to close that loophole. Okay, so now if you buy a property and if you don't hold it for more than a year, you're going to pay taxes on the full income. Then there's a luxury tax that is also new. You know, this came in late in 2022. So this again applies to sale of cars and aircraft with retail price over $100,000. So if you're buying expensive cars, again, yeah, be ready to pay these taxes when you sell those luxury items. Underused housing tax. So this is something that was very new. So this came in 2022. So we had to file these taxes for the first time last year. Again, we're going to file those again this year. Okay. So there are certain things to consider here. So if you own a home, not personally, if you own it in a corporation or in a trust, then and that home is not put into use, then you have to pay a tax because that home is vacant or underused. So there are certain rules that you have to be mindful of, and these are some of the rules, right? So you have to be a Canadian citizen or permanent resident that owns the property, and you have to own that property either as a trustee in a trust or as a partner in a partnership, or maybe you're a Canadian corporation, okay? If you're a non-citizen or a permanent resident, then yes, this rule will apply to you as well, or if you're a corporation outside of Canada. Okay, so all of these things you have to know for those of you that own rental real estate, and there's a late filing penalty as well, which is huge. So the filing deadline is April 30th for these tax returns. So these are some important dates to have in mind when it comes to filing taxes. So again, you will notice here a payment date and filing date. So for our personal tax returns, the filing date is April 30th. We also have to pay by that date, because if you don't pay, then interest and penalties will apply. If you're a sole proprietor, so if you run a business in your name, your filing deadline is now extended to June 15th. However, you still have to pay the taxes owing by April 30th. So what that means, you have to estimate how much you're owing. If you've not prepared your taxes, estimate and pay April 30th and then file on June 15th. The same thing with HST. If you have to file HST return, filing due date is June 15th, but again, you have to pay by April 30th. Okay, so finally, let me just talk about some tax tips and planning ideas as you consider 2023, preparing your taxes for 2023, and also as you consider for the future years. I think it's always important to think about the future as you plan. So I always encourage you to get organized, right? So put some systems in place, whether you do it online, electronically, or do it in paper. Just get folders, checklists to organize all your documents so that way you're not always stressed. And when it comes to tax time, and try to file on time. And the penalties now we see already they've increased, right? So they used to be minimal before, I think less than about 5% or less. Now they are 7% or even more in some cases. Okay, so you try to file on time to avoid penalties, particularly if you're owing taxes. And again, when you file on time, you also avoid reviews, you avoid audits and reassessments. So filing on time and filing accurately, right, will help you avoid all these reviews and audits. So very important to file on time, very important to get it right the first time so that you don't have to put yourself in a situation where you're making adjustments, making amendments, because anytime you're making an adjustment, particularly if the adjustment is favorable to you, then CRA, they don't like it. The government will not like it, so it may open you up to audits and reviews. And audits and reviews, all these things are timely, they are costly, and they're stressful. Okay, so just try to avoid those things. I talked about deductions earlier for a tax return. Remember, deductions will reduce your income to your taxable income. Okay, and so these are some examples of things you can use to reduce your income. So RRSP deductions, union dues, childcare expenses, disability support, moving expenses. So if you're moving for work or you're moving as a student, all of these things can help reduce your income. Support payments, if you pay support payment to your spouse, all of those things can help. Employment expenses. Carrying charges on interest. So if you borrow money to invest, so think about those of you that have line of credits and you're taking your line of credit to go into business, you're taking your line of credit to buy a rental property. All that interest you pay on your line of credit is deductible. Essentially, anytime you borrow money to earn income, then that interest on that money you borrow to earn income qualifies to be deductible against your income. Okay, so think about those things as you plan your taxes. Then obviously, if you own a business, if you own a rental property, there are things you can deduct. If you use your vehicle to run activities to generate income, then obviously you can deduct your vehicle-related costs. I talked about credits earlier as well. So credits are things that will reduce the amount of taxes you owe. Okay, and here are some examples. If you subscribe to any digital news, you can get some credits for that. The Canada training credits, donations. If you make donations to charitable organization, if you have medical expenses, I talked about the first-time home buyers. If you're buying home for the first time, that's a credit you can get. Then the disability tax credits and the school supply credits. So these are some examples of credits that you need to consider. It's also important to consider how you plan going forward. And so some of these ideas I talked about, if you're looking for ways to reduce your taxes in 2024, 2025, and in the future, I highly recommend you use TFSA if you're not using that tool. Think of ways to maximize your RRSP. Again, all these things you have to be, with the RRSP, you have to be mindful how you use it. Particularly if you have a very high income and you're in a good, if you have a good employer and your employer has a pension plan, then you got to be mindful how much you put in your RRSP, because by the time you start taking from your RRSP, taking from your pension plan, then you may end up in a situation where you're paying too much taxes, right? So remember, you're deferring taxes with RRSP. And so what that means, you're going to pay the taxes in the future. And if you think about where inflation, the amount of debt the government is owing, then tax rates are likely going to go up, right? And so that's why you have to be mindful in terms of how much you accumulate in your RRSP. Because one of the planning tips is, okay, to consider how you can take that money out with minimal tax impacts. So things to consider when you're planning. If you don't have a side business, consider starting a side business. And I always talk about this with my clients, okay? If you have a passion, think about ways you can convert your passion to a side business. Okay, so that way you can use some of the deductions again to help you minimize your taxes. And where possible, contribute securities to charitable organization, because those securities, if they have gain, then you get a full deductions for those gains. If you don't own a home, I talked about this before, if you don't own a home, get one. And the reason is because the proceeds when you sell is tax-free. You can leverage it to get into more investments. And obviously with the housing market, there's always a projection over the long term. These things tend to grow in value. Okay. If you already own your home, consider owning a few rental properties, because when you own a rental property, you're automatically in business of property. You're in the business of managing properties. Okay. And so when you're in that business, then you begin to get business write-offs, more leverage, and overall it's just tax efficient. If you're an employee, there are so many things you can do as well with your employer, right? So I shared a link there where you can review that and see some of the ideas to explore as you begin to negotiate with your employees. Because there are so many benefits that are tax-free, there are some that have minimum taxes. So all those things you can consider when you have a chat with your employee. I talked about the first home savings account. Again, think about ways to employ to use that if you're buying home for the first time. And then if you're buying home for the first time, you can also withdraw from your RRSP as well. Think about ways to use your marginal tax bracket to save on taxes. So remember earlier when I showed you those tax brackets? Now, if you're in a tax bracket, let's say you're in a tax bracket of $100,000 or more, consider the deductions you can use to bring your tax bracket from 100,000 to maybe 80,000, because that will not change how much taxes you pay. Okay, so think about ways you can plan around that. So how can I support you, right? So some of you know I'm a tax professional. I provide different types of services. So I do coaching services. So if you're thinking of ways to implement some of these ideas that I shared today, then consider engaging me for personal tax services, coaching services, and I can help you explore that. If you're looking to file your personal tax returns, we do have a service for that, and these are the different options we provide. The basic option going from $275 plus HST up to the more premium option, which is $1975. We also help with the tax efficient membership platforms. So this is something I shared earlier. We are relaunching this program in March. And so if it's something you're considering, so this is the plan here and the different options we have. Again, this is an annual rate. We've intentionally kept the rate, made it very cheap to get in. But again, there are benefits that you can explore from this program and this membership. Then obviously we also help corporations. If you own a business, so these are the different options we plan. So we offer to our corporate businesses. And these are the links. So I'll share this with you. So these are the links to get to all the services I talked about. I also have some additional resources here. So for the book, if you don't have a copy of the book, you can use this link to get a free digital copy that you can read. And then if you want the hard copy, you can always get a hard copy as well. Then there are other resources that I talked about earlier. Okay, how do you make 2024 your best year ever? The 2-minute mindset survey that I talked about, the 10 characteristics of a perfect investment vehicle. And then, yeah, finally, you can join my weekly newsletter that I share. And so if you join that link, you can get all of those too. And this is my contact information for those of you, if you're willing to, if you want to touch base, yeah, do get in touch. And I think that is it. So we can take questions now.
Thank you so much. I mean, I've been in Canada for 24 years, but I've learned so many new things today. I've always been afraid of taxes, though, filing taxes. So I leave it for my husband to do, but I think it's important for everybody to really know how to do this. You have a number of questions. This was such a helpful presentation. You have 1, 2, 3, 4, 5, 6. So let's start with some of us here are students and new to Canada. How do we file taxes?
Okay, so I mean, if you're new to Canada, yes, you should still file your taxes, even though you may not have income. Okay, and so to do that, yeah, find a tax professional to help you file. If you want us to help you, talk to me, we can help you. We have special rates for students. So we can always help you file your taxes as well. But as a student, I think it's important to file, particularly if you're a student considering to become a permanent resident in Canada, right? Because you have all these tuition credits that you're paying. Tuition credits is a big credit that can help you minimize taxes later in the future when you start earning income, because you don't lose those tuition credits. So always important to start tracking those tuition credits now, and the best way to start tracking it is to start filing your taxes on time as well.
Also, second question. Can you please define a resident and a non-resident? Is it based on the number of days you spend in Canada in spite of you being a citizen or PR holder?
Yes, it's mostly based on the number of days you spend in Canada, right? So there are certain definitions that make you a permanent resident in Canada. So remember, for those of you that are new, if you're a permanent resident, you'll realize that sometimes if you leave the country for an extended period of time, you may lose that residency, or you may be required to reapply. Okay, so I don't know those rules offhand intimately because I know they change all the time. But yes, your tax basis is based on residency in Canada. So if you're here for over 6 months, then yes, you're likely a Canadian resident for tax purposes for that year.
Next question is, based on tax deferred and tax free, would you say it's better to save your funds in a TFSA alone and not an RRSP when you still have to pay tax on it?
Well, I think it depends. It depends on your income. But this is what I suggest on a very high level. I think if your income is low, let's say you make less than $100,000 a year, and you're fairly new in Canada, or you're just fairly starting out, then I think it's best to try to maximize your TFSA. Okay, so try to maximize your TFSA first. If your income is low and you're just starting out in your career. But if you're at a place where your income is significant, right? If your income is significant, then you have the ability to maximize both. Okay, so in that case, obviously maximize your RRSP because that will give you an immediate tax break. And then you take the extra change you have and put in your TFSA. Okay, so that is what I would recommend. And I think it's good to use both as much as you can. But if you don't have the ability to use both and your income is low, then start with your TFSA.
Okay, all right, thank you. You talked about gross income and taxable income. Do you know if there's an app or calculator that helps you work out how much to put in, say, RRSP, so as to get the best taxable income that will work for you?
Yes, and there's a lot of online calculators you can find. So if you Google and search online tax calculators, you'll find a lot online that you can use, and then you can begin to make some changes to determine how much to put in your RRSP, and then how much to save. Then you can always ask your tax advisor or your accountant, and they can also help you just look at your income and then determine how much you can save when you contribute to your RRSP. And particularly now that we have a little bit of time, I think end of February, that's when you have, that's the deadline to contribute to your RRSP. So hopefully by now you know what your income is in 2023. And so because you know what your income is, we can easily estimate how much your tax liability will be. And we can easily tell you how much your taxes will reduce when you contribute to your RRSP before end of next month.
Okay. So can you give examples of how to convert after-tax expenses to before-tax expenses?
Yes, and the easiest one is gonna be owning a business. Okay. So let's say, okay, so let me just give you a quick example. So let's say I work for RBC. Okay, so I work for RBC and I make 100 grand every year with RBC. Now, what RBC will do, they are required by law to deduct and to withhold the taxes. Okay, so they'll take all that money up front and they will give me the net amount. And now I'm gonna take that net amount and I'll pay for my gas, I'll pay for all my expenses, and I'll pay for all of this. So now I'm using my after-tax dollars to pay for all these expenses. So now, what if I go to RBC and say, okay, now I resign, I don't work with RBC again, but now they hire me as a consultant. Okay, so they hire me as a consultant, and now I'm working for them using my corporation as a business, as a consultant, and I'm still making the same 100 grand. Okay, so now RBC is not withholding anything. So they're giving me the entire 100 grand. It comes to my account. And now, because I'm a business person, I may be able to withdraw I may be able to deduct my car expenses. I may be able to deduct my home expenses because now I work from home. I may be able to deduct. So now at the end of the day, my taxable income will no longer be 100 grand. It may be 80, it may be 70. Okay. But again, realize that if you're only working for one employer, then you have this personal services business. So there may be some implications. So you have to obviously think about some of the consequences and ideas. So you have to be working with multiple, you should have multiple customers to be able to deduct more from your income. But that's just a simplistic idea, right? The fact that if I run my business, there are multiple things I can deduct to reduce my taxable income from 100 grand in this example to maybe 80 or 70. Okay, and that is one way you convert your non-deductible interest to deductible interest. And then the second example is this. So let's say I own a home and I rent a portion of my home. Okay, so I own a home, I rent a portion of my home. Remember, I told you earlier that we don't expense or we don't deduct the interest we pay on our mortgage. But now, once I start renting a portion of my home, then now I'm able to deduct a portion of my interest that I pay on my mortgage. Okay, so there are just a few hacks that you can use to minimize taxes and to convert things from an after-tax basis from before tax basis to after tax basis.
You've got my mind working. Another question. What is the implication of not filing taxes based on your world tax?
Well, that's a good question. So in general, the implication is once the government finds out, then now they will add that income that you did not disclose. They will add it to your income. They will assess penalties. They will assess taxes, and they will backdate it for how long you've not been reporting income, right? So that's the implication. Now, let's say you earn income from Nigeria, right? And you don't disclose it in your Canadian tax return, and you're a Canadian resident for tax purposes. Now, because the government and Nigeria, I don't know how much tax information they share, it's likely they don't share a lot, it's likely they will never find out, okay? But again, if you're moving money from your account in Nigeria to your account in Canada, then again, government may have an idea, right? If they get to know, okay? So our Canadian tax system is sort of built on trust. So the government essentially trusts us to disclose and to report our total income, okay? So we have the responsibility to disclose. The government, on the other hand, they rely on what we give them, and then they randomly pick people to audit to see whether you actually reported the actual amount for taxes. So to answer your question, the implication is if they find out, then you'll be liable for penalties, you'll be liable for interest. And then sometimes you may be liable for gross negligence, which is a big fine, okay, and may land you in jail. So those are some of the things to be aware of when you're not disclosing your income.
Thank you. So we can actually get into trouble, big trouble, if we
That's
don't.
right.
Yeah. Okay. Another question. What about a corporation? Should you always pay yourself, then invest, or invest in a corporation? Should you always pay yourself, then invest, or invest in a corporation?
Well, I think you pay yourself if you need the money to sustain your personal day-to-day living expenses, okay? So if you have a corporation and you're using a corporation for your business, we always recommend you pay yourself salaries. And sometimes, depending on your level of income, we recommend a combination of salaries and dividends. And then the excess amount that you don't need to fund your personal living expenses, you leave it in the corporation and you invest it in the corporation. Okay, because anytime you take money out from the corporation, you pay taxes on the money. Okay, so that's why we recommend you leave as much as you can within the corporation, and there are ways you can invest it within the corporation and take the money out later more tax efficiently. So that's what we recommend. You only take out what you need to sustain your day-to-day living expenses.
Okay. So just to reiterate, whenever you take out money from the corporation, it will be taxed.
It will be taxed. Again, it depends on how you take it out, okay? So when you have money in the corporation, there are essentially a few ways you can take it out. You can borrow the money from the corporation. So if you borrow the money, you can repay within a year, no tax consequences, okay? So that's one way. Secondly, you can just pay yourself salary. Okay, so if you pay yourself salary, the corporation gets a deduction. But now that salary you report in your personal tax return. Thirdly, you can pay yourself dividends. When you pay yourself dividends, the corporation pays taxes on the income because now you're paying yourself dividends out of retained earnings that has already been taxed. Then now that dividend, you now pay yourself and then you report that in your personal tax return. But you get a credit for the taxes you've already paid in your corporation. Okay. So those are the only three ways you can essentially pull money out of your corporation. Because if you don't follow any of these three ways, if you just take it out, then what the government will do, they'll take that money and they'll put in your personal tax return and you pay taxes on it.
So it will be double taxes?
Essentially double tax, that's right.
Okay. This question is kind of related to, well, kind of. So I know in the past, I saw you wrote something here saying income split. You can split your income with family members.
Yep.
Can you explain that a little bit? Because I thought they no longer allow that.
Well, there are some rules because it used to be abused in the past. Okay, so now what the government did, I think just a few years ago, they put some rules around how you can split income with your family. So there are rules and there are limits. Okay, you can still do it. It's just that it's very limited now. Okay, in terms of how you can suppose do it. But I can give you a quick example. So let's say I own a business. If I own a business and I have grown-up kids, so right now I have 13, sorry, I have a 14-year-old, I have a 16-year-old. So I have kids and they are old enough to do work for me, okay? So long as I pay them and they do the work and I pay them market rates for the work they're doing for me, they're documenting their time, then yes, I can legitimately deduct that money as expense that I pay to them in my business, okay? And because they are young and they probably don't have other sources of income, I can pay them as much as $13,000. Okay, so if I have 2 kids, I can expense about 26 grand from my business that I don't have to pay taxes on. They can report 13,000 each in their personal tax return. They don't have to pay taxes on. So things like that you can still do. Okay, you can split that way. If you have pension income, you can split that with your spouse. That is still allowable. So those are things you can do. If you have a business and your partner or your spouse is a shareholder as well in your business, then obviously you can still pay them dividend income, right? Because they own the business. Okay. But now in the past, we used to be arbitrary. We can arbitrarily just give money to anybody, right? But now there's a little bit more documentation required. There has to be proof that they're actually working in the business. There has to be proof that you're paying a market rate. All of these things have to be in place now to be able to split income.
Okay, thank you. So follow up to the question about the corporation. The person said, so if the money is not needed to sustain your personal expenses, are you saying it's better to leave it in the corporation and invest from there? Because I thought corporation tax for investment is higher and corporations do not have registered accounts.
Well, that's right. Corporations don't have registered accounts. But yes, you can invest it there and have it taxed in the corporation. Yes, the taxes in the corporation is going to be different depending on the type of income, okay, in the corporation. Now, if you have an active corporation or active business, because there are different types of corporation you can have. If you have a corporation that only earns passive income, then your tax rate is going to be much higher. Okay, so examples would be a corporation that only owns rental property, or a corporation that only owns investments and they only own rental income. Okay, all those tax rates will be higher. But if you have a corporation where you're actively doing business, then your tax rate will be lower, right? 13% of taxes, that's what you pay. Now, depending on the type of rental income that you have, okay, because sometimes if you have investment income, if that income is not as significant, if it's insignificant, then your tax rate is still going to be low. If it's significant, then now the government can consider that corporation as a whole to say, well, that corporation does no longer qualifies as an active business because you have so much passive income in that corporation. But I think at the end of the day, if you consider the fact that, well, that income is still going to be taxed personally anyway, right? If you invest it personally, the rates are still going to be similar, right? So you just want to pay the interest or the taxes on that income in the corporation, because anytime you pull it out from the corporation, you pay taxes by pulling the money in the corporation. So it's best to just leave it in the corporation and only pay taxes on the income earned by that money in the corporation, rather than paying taxes on the capital when you pull it out from the corporation.
Okay, thank you. How old are your children required to be by law before you can pay them market rate?
Well, there's really no limit on age. The most important thing is, are they able to do the work that you want them to do? Okay. So if they demonstrate ability to do the work for you, then yes, you can pay them market rates based on their ability to do the work. So the abilities, the rates the rate is not based on age. It's based on the ability for them to perform the task.
Okay, thank you. If you work abroad, say England, and already pay tax on the salary end, should you be paying additional tax again in Canada?
Well, you get what we call a tax credit, a foreign tax credit. Okay, so let's say you made money in Nigeria or in the UK, and you paid $5 in taxes there. Okay, when you come to Canada, you report that same money here. The tax in Canada may be $10, but you get a foreign tax credit for the $5 you paid in the UK. Okay, to offset that $10, to offset the taxes that you paid in the UK.
Okay, thank you. So that answers this question. Do you pay taxes on funds made outside Canada? If yes, does it mean we end up paying double? That's the same question.
Yeah, it's the same question.
Yeah. And there's another question here. As a new PR, can you skip your first year tax filing and file in the second year?
No, you're required to file your first year. So you're required to file from the day you landed in Canada. So if you landed in November 2023, then you should be filing taxes this year because you were here for November and December in 2023. Okay, so your first tax return will be from November to December 2023.
Okay, thank you. Great questions, everybody. It means we were all tuned in. So those are all the questions. We don't have any more. Oh, wait, sorry, one more. For a non-resident, for instance, who is a UK citizen and came to Canada to work, how much do you have to make in order to pay tax?
Well, if you make more than $13,000, you likely pay taxes. Yeah.
Okay. All right.
Yeah, sorry, Ken. I was just going to ask if you can go back to that slide that that showed the taxes that you pay based on your income. Just like if you can take us back quickly, if that's okay.
Okay. All right. So let me see if I can go back there. So the tax rates, right?
Exactly.
Down here. Okay, so all right, so I have it here. I'll share my screen. We're talking about this one here, right?
I think this one. Is this the one you want?
Yes, that's the one. Yeah, exactly. Okay. I guess that's what the person's also asking. So taxes start from 13th. Okay. So the more you make, the more taxes. Right.
I have a question on that. Do they combine incomes here, or is it just for if you're a married couple, do they combine the incomes together?
No. So if you're married, both of you can file your taxes together, but at the end of the day, we're submitting two separate taxes. So there is one for your spouse, there is one for you. Okay, but what happens, the reason why we like to file the taxes together for both partners is because there are sometimes you can move things from one person to the other to maximize or to minimize the taxes paid as a family. Okay, so that's why we always recommend spouses to file together. Oftentimes we recommend the entire family to file together because there are opportunities to move things around from one family member to the other. So that way we can optimize the tax for the entire family. Because if we fight separately, it's hard for us to do that for you. But if we fight together, we can do that.
Okay, they want you to post your, thank you. They want you to post your contact details. I'll post that actually. But there's one last question on the mortgage interest, which is not allowed. What about the principal element of mortgage? Do you deduct that as an expense?
All right, no, you never deduct principal or capital invested anywhere. But again, if you have a rent, except it's business, okay? So let me give you a quick example. So if I buy a house for $1 million and it's my primary residence, I don't get any deductions for that 1 million. Okay. I've spent it, is a sunk cost. I don't get any deductions until I sell my home. So I buy a home for $1 million, I sell it for 1.5, then yes, I can get that gain for $500,000, no taxes, no tax implication. Okay. Now, if I buy another home for $1 million, and now it's not my primary residence, it's a rental property. Okay. I spend $1 million, I buy a rental property. Because now that property is a business, I can deduct a portion of that $1 million every year, so long as I own that rental property. So I can own that rental property for 50, 70 years. And this is what we call the capital cost allowance or the depreciation and amortization. And so that's why rental property is so key, because it's so tax efficient. You can use this deduction to just defer taxes, essentially, for many years when you own a rental property. Then when you sell it, that's when those deductions will be added back, and then you pay taxes at that point on the rental property. It's the same thing with the business. If you buy a capital, if you buy an equipment, let's say you run a manufacturing business and you buy an equipment for 100 grand. It's the same thing. That equipment cost, you spent 100 grand, you cannot deduct the capital cost of that equipment over time in your business.
Okay. Okay. Somebody's asking if we would get the recording of this.
Yes, so I'm going to share the recording. I'll also share all the slides. So just give me maybe later tonight or sometime tomorrow. Once I have the recording processed, then I can share that. I think I have the email addresses of everyone that registered. I will send it to that email. And then if you don't have it, just send a text to Nene or someone and she will forward it to you.
So sorry, Ken, we have your contact here. Is it okay for people to reach out to you? We have the contact on the chat.
Oh, yes, yes. Feel free
Okay.
to reach out to me. Yeah, send me an email, text, or call, and I'll be happy to have a conversation with you.
And
Is
please,
it allowed to,
oh, sorry, go on.
is it allowed to can we put your contact on NCH?
Yes, for sure, certainly.
All right, good. Thank you.
And please feel free to go to Ken Green's website, www.taxefficientworld.ca. The amount of information in there is, you'll be surprised at how much is in there. And sign up for his newsletter. I get it all the time, and then I read it, and there's so much that I've learned from it. So thank you so much to everybody who has joined. Clearly, with all the questions, it means that people were really, tuned in
That's
and
right.
really benefited. So thank you so much. It's tax time, February, so please reach out to Ken Green to help you with your taxes. And he has a reduced rate, he said, for new, did you say students? For students, right?
For students, mostly
Yeah.
for students. But I mean, if you're a new immigrant, you don't have income, then maybe I should be able to negotiate something with my partner for new immigrants. So yeah, just reach out and we can have a conversation around that.
Okay, so
Sorry.
if you want to stay, anybody that wants to stay to ask more questions, you can. The webinar is now officially over, but Mr. Green will be here to take any questions. So you can just unmute and ask your question if you have a question, or post it in there. Thank you so
That's
much.
right. Yeah, you're
Yeah,
welcome. And I will stop the recording.
Thank you so much.